Kospi hit limit down. That's Korea suspending trading because stocks fell too fast. Oil is bid, gold is bid, equities are offered. An advisor to Iran's Revolutionary Guard warned that forces, quote, will set fire to any ship attempting to pass through the Strait of Hormuz. That's not posturing. That's 20% of global oil transit. The Strait of Hormuz is the choke point between the Persian Gulf and the open ocean. Shipping has effectively ceased. Iraq is curtailing production at the Rumaila oil field because tankers can't move. 3 million barrels per day, gone from global supply. This news was tracked and brought to you by PIQ, the detailed customizable dashboard that is free for users. Follow them at PIQ Suite on X. Is this the start of World War III? That's the question I'm seeing everywhere this morning. Kospi hit limit down. Amazon facilities in the Gulf got hit by drones. Oil's ripping. The VIX is above 24. And I get it. When you see Iran and escalation in the same headline for the 5th straight day, the lizard brain takes over. But here's the thing most people are missing, and I'll show you the data in a moment. This conflict, as scary as it looks, may actually be the healthy outcome for markets. Let me explain. This is your 60-second class. For months, we've been tracking something called crowded positioning. It's exactly what it sounds like. Too many people on the same side of the trade. And since November, the data has been screaming that professional traders, retail traders, systematic funds, everyone, was piling into risk assets. When everyone's long, there's no one left to buy. And worse, any shock becomes an exit event. Here's what I didn't fully appreciate until this week. Geopolitical shocks don't just hurt markets. They clear markets. They force the weak hands out. They reset the positioning. So when our macro strategist says, and I'm quoting here, the highest probability outcome is that this too shall pass, and once it does, it will likely leave asset markets in a much healthier condition. That's not optimism. That's mechanics. The crowded positioning that's been a headwind, this conflict is burning it off. Write that down. Let's get into what actually happened overnight. First, the conflict. The Iran campaign continues. Asia markets slumped hard. Kospi hit limit down. That's Korea suspending trading because stocks fell too fast. Oil is bid, gold is bid, equities are offered. An advisor to Iran's Revolutionary Guard warned that forces, quote, will set fire to any ship attempting to pass through the Strait of Hormuz. That's not posturing. That's 20% of global oil transit. The Strait of Hormuz is the choke point between the Persian Gulf and the open ocean. Shipping has effectively ceased. Iraq is curtailing production at the Rumaila oil field because tankers can't move. 3 million barrels per day, gone from global supply as long as wartime conditions hold. Bearish for consumers, bullish for energy names. This is an inflation accelerant. Second, infrastructure hits. Amazon confirmed 3 of its facilities in the UAE and Bahrain were damaged by drone strikes. Cloud infrastructure in a war zone is vulnerable. That's not theoretical anymore. Third, U.S. policy response. Trump said the Navy will protect commercial shipping if necessary. He's also threatening Spain with trade retaliation after they denied U.S. use of military bases. Defense Secretary Hegseth dismissed the premise of an endless war, but Trump said operations could extend far longer than 4 or 5 weeks. Fourth, on the earnings front, CrowdStrike beat expectations and guided higher. Management cited elevated demand for cybersecurity in the AI era. That's validation for the cyber thesis, and Iran conflict only raises awareness of digital threats. Now let's talk about the fear gauges, because this is where you separate noise from signal. VIX, the volatility index. VIX measures the market's expectation of 30-day volatility. When traders are scared, they buy protection, and VIX rises. VIX closed at 24.29, up 3% from yesterday's close. VIX futures, the front-month contract, are trading at 23.2. We're in elevated territory. 24 is not panic, but it's not calm either. This is hedging demand. Elevated VIX means options are expensive, hedging costs are up, institutions get more cautious. The VIX term structure. The relationship between near-term and longer-term VIX futures. Normally, further out futures trade higher than near-term. That's called contango. We're still in contango, but it's flattening. The 3-month VIX is barely above spot. The market expects volatility to persist, not spike and collapse. This isn't a one-day panic. It's sustained uncertainty. A flat term structure means no quick resolution is priced in. VVX, the volatility of volatility. VVX measures how much the VIX itself is expected to move. Think of it as the fear of fear. VVX is elevated running above 120. The VVX to VIX ratio is around 5. That's in the normal range, meaning options are fairly priced relative to spot VIX. The volatility range is expanding, but it's not extreme. Hedging costs are up, but we're not in panic territory. It's rational hedging. DXY, the dollar index. DXY is at 98.99, essentially flat overnight, down 6 basis points. The dollar isn't screaming flight to safety. That's interesting. Gold is catching the safe haven bid instead. Neutral to slightly bullish for multinationals. A flat dollar means no headwind from currency translation. Breadth, equal weight versus cap weight. Both are down, but small caps are underperforming. Russell futures down 26 basis points versus Nasdaq down 23. This is a risk-off rotation. Money is hiding in quality, not reaching for beta. Bearish for small caps. If you're long IWM, you're fighting the tape today. Let's look at what the quant model is telling us. The regime, risk on. That might surprise you given the headlines, but the quantitative regime map hasn't flipped. Growth index is at 100.05, neutral. Inflation index is at 100.20, slightly bullish bias. The systematic models haven't panicked. They're seeing this as volatility within a risk-on regime, not a regime change. The quant model's positioning, heavily concentrated in leveraged Nasdaq exposure with cash as the only hedge. No bonds. No gold in the quant model specifically. Current drawdown. The quant strategy is down about 20% from its peak. The benchmark, the S&P, is down only 2%. That's the cost of leverage in a choppy tape. The probable range model is showing something important. The S&P, Nasdaq, and Russell are all oversold. Meanwhile, the dollar, yields, and Brent crude are overbought. Write that down. Oversold doesn't mean buy now, but it means the easy short is probably done. Now let's ground ourselves in the actual economic data. Inflation, CPI. Headline CPI is at 2.39% year over year. Core CPI, stripping out food and energy, is at 2.51%. Inflation is sticky. The February ISM manufacturing data strongly supported the sticky inflation thesis. We're not going back to 2% anytime soon. Sticky inflation means the Fed stays cautious. That's a headwind for rate-sensitive sectors, but it's not accelerating, so no panic. Inflation swaps, what the bond market expects. 2-year swaps at 2.39%, 5-year at 2.33, 10-year at 2.33. The curve is flat to slightly inverted. The bond market expects inflation to stay around 2.3% for the next decade. This is priced in. Growth, real GDP. Real GDP at 3.53% annualized. Real final sales at 2.6%. The economy is growing above trend, but yesterday's ISM manufacturing data did not support the accelerating growth thesis. The new orders minus inventory spread is cooling. Industrial momentum is not yet on solid footing. Growth of 3.5% is healthy, but the forward indicators are softening. Labor market. Initial claims last reading was 212,000. That's healthy. Unemployment rate at 4.3%. The labor market remains resilient. No cracks yet. Bullish for consumer-facing sectors. Employed people spend money. What's the Fed thinking? The Fed monitor shows implied rate changes are basically flat. The market is pricing in 0.3 cuts over the next year. That's essentially nothing. Terminal rates. The bond market sees the terminal minimum at 3.06%, terminal maximum at 4.08, with the policy rate current mark yields. The 2-year is at 3.51. The 10-year is at 4.06. The 30-year is at 4.70. That's a normal upward sloping curve. No inversion, no recession signal from the yield curve. The Fed is on hold. They're not cutting into an inflation scare, and they're not hiking into a growth scare. They're waiting. The overnight rates tell you something else. The tri-party repo rate is at 3.69, above the interest on reserve balances. That's tight. Liquidity isn't abundant. Globally, the Bank of Japan may delay further normalization. Japan's unemployment data was soft. The ECB is steady. No surprises from other central banks. Let's run through the sector signals quickly. U.S. equity sectors, momentum conditions, bullish, materials, communications, energy, industrials, staples, real estate, utilities, healthcare. Neutral, meaning half position, financials, tech, consumer discretionary. Notice that. Tech and financials, two of the biggest sectors, are only showing neutral momentum. The leadership is rotating. U.S. equity factors, bullish, value, small caps, mid caps, momentum, quality, high beta, high dividend, low volatility, the broad market. Neutral, growth specifically. Global equities, bullish, international developed, emerging markets, Japan, Brazil, Europe, Australia, Canada, UK, neutral, China, India. Fixed income, bullish, aggregate bonds, intermediate treasuries, investment grade corporates, tips, neutral, high yield, senior loans. Bearish, meaning no position, international bonds. That's notable. The momentum signal is telling you to avoid international fixed income right now. Macro exposures, the big directional calls, bullish, gold, gold miners, silver miners, oil, base metals, commodities broadly, and short the dollar. Bearish, meaning no position, Bitcoin, Ethereum, agriculture. Bitcoin momentum is bearish. Ethereum momentum is bearish. If you're long crypto, you're fighting the signal. Here's what our macro strategist is saying, and this is important context. Key question of the day, is this World War III? Answer, highly unlikely. The highest probability outcome is that this conflict passes and leaves markets healthier by clearing the crowded positioning. Active theses. 1. Sticky inflation. Supported by yesterday's ISM data. 2. Resilient U.S. economy. Still intact, but growth momentum needs to firm up. 3. Paradigm C. The accelerating growth thesis. Not supported by yesterday's ISM. New orders minus inventories is cooling. The bottom line from the strategist, we're in a Goldilocks regime. Growth up, inflation down on a trend basis. The 12-month outlook is bullish. But, and this is critical, crowded bullish positioning will create violent chop amid a white-knuckle grind higher. Don't expect smooth sailing. Expect exactly what we're seeing, big swings, scary headlines, but no regime change. Let's compare the two models, the quant model and the macro strategist. The quant model is positioned heavily in leveraged NASDAQ exposure with the rest in cash. No bonds, no gold, no Bitcoin, pure risk on equity concentration. The macro strategist is positioned in global stocks, heavy in gold, minimal cash, and no Bitcoin. The key difference, the strategist is expressing a global diversification thesis, owning the world, not just US tech. And the strategist is expressing a gold thesis, hard assets as an inflation hedge and safe haven. Common ground, neither model owns Bitcoin. Neither model owns bonds heavily. Both are positioned for equities to grind higher despite the chop. Here's your bottom line for Wednesday, March 4th. The Iran conflict is real. The supply shock is real. 3 million barrels a day gone. But the market is treating this as volatility within a risk-on regime, not a regime change. The ISM data did not support accelerating growth. It did support sticky inflation. That's a mixed bag, but it's not bearish enough to flip the models. Equities are oversold. The dollar and yields are overbought. The momentum signals are bullish for gold, oil, and global equities, bearish for crypto. Expect chop. Expect scary headlines. But the base case remains a grind higher, white knuckle, uncomfortable, but higher. See you tomorrow. If you want to learn the daily profiler framework,
Hi, good morning. Matthew Mickey doing my Wargame analysis for March 4th. Currently it's a Wednesday, right? We see that we're stuck in previous month NFP Friday's range, right? We're below previous month 50%. We're anticipating this to be the monthly slowdown, if not a quarterly pullback for this month. We're going to be paying close attention on Friday and Monday to see if we can get pushed out of the current range that we're in. And then from a candle science perspective, let's look at it. Let me move these lines. Right, so we're trying to use yesterday and the day before to figure out which one has the higher probability. So let's go over to our candle science platform. All right, and let's put in yesterday and the day before. So the day before was green, yesterday was red, and we took out the low. Right, so today we can see that the low currently has a 65% probability of being taken out, where the high, let me bring this in a little bit, where the high actually has a 25%. So just based off of the last 2 days, there's more likelihood to take it the low than the high, right? So now, like, what happens if we lose the opening price right there? Obviously, it will flip up, right? We've already lost previous day mid, but we're going to go deeper into, we're going to go deeper into our intraday session statistics to kind of figure that part out, right? So now what I want to see is if we do take out that opening price, because we got the first alert, which is taking out previous day mid, then we can see that the above, the high takes a 64 and then the low takes a 44. And we've already got the alert for that to be happening. So 64 right here. Ah, damn it. And then the lower one will be a 44, right? And we do have the alert right now of the previous day high having the higher probability, right? Like right now during the New York Open, it will show its hand. It either comes up here and goes in the extended, or it reverses, right? So let's say it does take out that previous day high, right? Where do we expect reversal from, right? Or the high of the day, right? We can see that the 30th percentile reversal zone is at the 0.20, which would be right here. And then the 50th percentile reversal zone would be at 0.31 where it says median. Right? We know that the 50th to the 70th is from 0.31 to 0.54, so half a basis points off a previous day high. Which would be right there, right? And since we got the alert, this is where we're expecting high of the day zone to line up. Right around here. So highest probable area is 25092, right? So now coming from a weekly chart, we can see that we're above Tuesday's range, we're above Sunday, so we're expecting this low of the week to hold, right? The day will show its hand, right? Wednesday has the most highest probability to be inside of Sunday's range that we use. We know that we have an 85% probability to hit 25,231, right, on the NASDAQ, and that's where we're aiming for today's target, right? All right, and that also 25,231, that lines up with it's a little bit higher than our 70th percentile zone. So maybe we don't hit that target today. All right. All right. So we can see, right, this will be key, right? Because as live price momentum is showing us that we can lock this in as low of the week because we're above Sunday and Tuesday. However, as we approach this high, we're going to pay close attention to can we step above that to hit these high probability targets from a weekly perspective, right? Which this one has an 84% probability and this one has a 75% probability. Now moving to the intraday side of the house, right? We can see we got contradicting markets. We got Asia selling off, we got London buying up, right? So right out the gate, if we come over to the profiler, right, and we put that in, let me go back to NASDAQ. I was messing around with gold today. Right, we can see this was short true open, short true broken, all right, they got hit already, and long true open. So right out the gate, we can see that London has a 76% probability retracement between 9:30 and 10:15. So right out the gate, we know that this area right here, London OU to midnight, is a zone that we're going to pay attention to. Right? Now let's go look at the low of the day, high of the day status. Have we broken out? We still have not broken out. Oh, annoying. All right, so right out the gate, and I broke it. We'll just do it this way. Right out the gate, looking at our high day, low day time, right? We can see our current low of the day is at 120, our current high of the day is at 810. 120, 86 basis points, right? We can see that there is data right here to support that. Now we're going to see, and then 0.86 basis points would put us right here. So that's a pretty healthy, still within the bell-shaped curve of a low of the day, nothing anomaly. So now if we break up to the upside and we do a false, we know that the mode to median for a false is between 0.4 and 0.8, so that nails it, right? We can see that from a time standpoint, it's more like if we did put this in at 120 during this cluster of data, there's a high likelihood of the high of the day coming in, right? Now, there's a couple of scenarios that can play out right here. for a false. Let me remember how to draw on this thing. Right? This is your current low of the day right here. Right? That means your high of the day can happen right here if distro allows it. Now we've already spent our 10-day median range. Right? We're overspending in Asia and London. And we've already spent majority of New York's quarterly, right, from 7:30 to 11:30. So if we see that we get reversion to the mean at 9:30 and we start sucking back into the range, we have to accept that this is your high of the day and this is your low of the day, right? Or this, we put in a high of the day to put in a new low of the day right here. It doesn't look like we're going to put a low of the day in to make a new high of the day yet, right? So that's not one I'm even considering, right? So, right, that would be if we do a long false, right? But the biggest obvious signature is expect high of the day for 9:30 to 10:15. That means we should be expecting reversion. Well, we spent the range, so that would need, I would need to see some kind of news to support that, to make a new higher prices for the end of the day, high of the day, right? Long true, right, supports very much from a time standpoint that low of the day, and then we'd be expecting high of the day, right? So we can't do the 4-step, we break out. Good grief. So we know that there's 4 possible scenarios that can play out around the 7:30 to 8:30, and we've incorporated what Asia did and London did, right? So we can do this right here. By 11:30, we take out both sides of this 7:30 to 8:30, or we can do this right here between 7:30 and 11:30, where we go up. We can retrace into this range, but we're not going to take out the low. We can do this right here, because we have not broken out yet, right? Which would be a short true, and we cannot take out the high between now and 11:30. Or we can do something like this right here, where we do take out the high. Now, once we break out of this zone initially, we will be waiting. We'll be able to eliminate 2 of these. Give me 1 second. All right, I'm back. So, like, if we come to break out to the short side right here, right now, that, from a statistical standpoint, typically points to a short true, right? But anyway, right? So we know this much right now, right? We know that we've overspent our range, right? From a 10-day median standpoint, we know that New York 1 has already spent over the last 16 weeks on a Wednesday. The median is 97 basis points, and we've already spent 85 by New York 1. So we're either going to expand or we're going to do something like this where we overspend, right? Come take out previous day high and shop, or we just have this serious retracement back for a short true kind of day, right? So that's what I'm going to be looking at, right? So we're either going to get a long, and then like we can get a false right here, because as we go forward, right, if we get a long false, these are all high probable retracements. We just saw London OU, which has a higher probability between now and 11:30 of getting hit. We know midnight has a higher probability of getting hit. But if we turn around right here and break to the downside and turn this short, we know we're more likely, because of this deep retracement and the size of the New York 1, to do a short true. So for longs, we're expecting long false. If we break out shorts, we're expecting short true. All right. So with that being said, all right, let's move on with the long false scenario. All right. So we know that there's a couple of zones of interest that we're going to be paying attention to. Our previous 12-hour mid, our London OU and our midnight, and a new low day. Our higher day is at 8:10. Well, that's supported. All right. So if we do long false, we can see that we have data right here. Usually it's news that drives it, that will facilitate that move, right? And then the biggest thing is as we trend down, because like think of it like this, right? Let's go to the daily chart. All we've done overnight was retrace yesterday's candle, right? Look how many times, like on a daily chart, we retraced and then reversed. Like this one, right? We retraced into the wick and then we reversed, right? Like, so what we did overnight is, can this daily candle right now can easily turn to a red candle. We can retrace into previous day body and then we can reverse, right? That's more like what the long false is supporting. The question we have to ask ourselves, if we break out of long, is it going to come to this footprint or the previous day wick or more into the body and then reverse, or does it need to take out this high and then reverse, right? So now let's use some data to kind of question that. Our current high of the day is at 89 basis points at 810, right? So for a long false, right, we can see right here is towards the outskirts of this bell-shaped curve of data right here with the mode, the median. So like right here, we looked at a bell-shaped curve, we would know that this is a drop-off point where we currently are. So for us to get above 0.9%, which we're currently at, to get up to here, we would have to go into anomaly price behavior, right? So with that being said, right, if we come up and we break to the upside, right, I know that we have all these high probability numbers that we like to retrace to, right, such as settlement to Globex open, P12 mid, right, previous day mid, right, that we're going to be targeting. So if we go look at these, we can see, right, P12 mid has a 91% probability of being retraced, with the secondary mode being between 9:30 and 10:15, right? We know midnight has a 75% based off what Asia and London did, right? It's actually at 59 if we take out that false scenario. But either way, if we go long false, long true, it would definitely drop, right? We should have already hit it, right? But anyway, if we go false with the longs, we know that this is a high probable target. We know settlement's a high probable target. We know that RTH gaps are high probable targets. But so we know we have all these targets to play with if we break out to the long side. But what we have to see, because like momentum's up, momentum's been up since 1 o'clock this morning. Like you don't want to buy, you don't want to get caught selling rips when momentum's up, right? So we do something called a 4-step reversal, right? This is the 9 o'clock hour, right? Let's say it's up, right? And this would represent the 9:30 candle, right? 1-minute candle, high to low. We start accepting below the 9:30, and if we can get below 9 o'clock's 50%, we're allowed to start taking a fourth of the position in cells to start targeting this, or we're allowed to take full position and cover our queen around 5 to 10 basis points. But we got to account for the risk that we're more likely to get stopped out because we're fighting momentum, right? But these two elements allow us to, start putting risk on the table, but we're going to have to be able to mitigate that risk through covering the queen or just sizing in a fourth of the position at a time, right? You don't want to put a full position on selling a market that's going up, right? It doesn't make sense to position size in the reversal like that. You have to have if-then statements that like get you into that full position. Now, if we break to the downside, like let's say right here, right now, we stay in this range until 9:30, and 9:30 opens up here. If we start selling out of the 9:30 range, right, I will take sells on with full size, and I'll target covering my queen to around 10 basis points. I'll target settlement, Globex open, but highest probable area right now, if we start selling, is this previous 12-hour mid, which is currently at previous day mid, magic, which is at price level 24,685, right? And then I'll start leaving runners for a new low day, a midnight open, et cetera, and I'll try to capture a lot more of that sell. But today is going to be one of those days where patience has to be executed, right? We know that we're in volatility is expanding, right? Which means it's going to be an expensive market anyway. We know that these ranges are getting larger, And we know right now we're in an undefined situation, right? Yes, we can expect new higher day and lower day, but right, because how much we've spent already in the range, right? You've got to be smart about this. If 930, for longs, if 930 gives me longs, I'm covering the queen at 5 basis points and taking cash flow targets around 10 to 15 basis points, right? So the sells with a higher probability. However, right, I'll be very smart about how I get into the sells. If it keeps bidding up, I'll keep bidding it up with cash flow targets because we've already overspent majority of the range. So there's no foaming at the mouth trade today. This is going to be a day of discipline and just being very strategic with any trades that I take. Right. So the biggest thing that you guys have to listen to is like you got to ask yourself today, after you take your 930 trade, is the next trade that you take, does it have as much, if not more, edge than the 930 trade? If the answer is no, you should probably be done for the day. But that's my war game today. It's not going to be as juicy and cool as most days because of what we've done overnight, but we know that we're expecting a long false or a short true, right? Trade it as you will. All right. Hopefully this helped.